With civil unrest in the US and the US-China trade agreement in deadlock, how is this affecting the market? This and much more with Bob Mason of FX Empire. This is your midweek market drivers. Hello, Bob, and thank you once again for joining us. Let's kick off with the geopolitical events occurring this week. In the US, the civil unrest is currently going on, which you actually forecast earlier in the year. But how about the US-China trade agreement? How's that hanging right now?
Yes, on the US-China trade deal, we've seen, obviously the US and Trump flex his muscles last week on Friday. And on Monday, we heard China talk of banning the import of soybeans and obviously pork from the US. But then state-owned enterprises continue to import soybeans on Monday. So that's a bit more arm flexing as well. So both sides have shown their intent in terms of what they're willing to do, but they've yet to do that. So that's provided the risk appetite through the first half of the week. All of that could change at the drop of a hat, however. So the markets do need to be a little bit cautious, should tensions escalate, in the coming days, because that could lead to exactly what both sides have suggested, they plan to do. So phase one agreement is still in place. China's still sticking to, the phase one agreement, as are the US. So for now, it's status quo. But, some caution is required, over the coming weeks, because, this is not over by a long shot. And Trump wants to, distract the markets, continue to, over COVID-19 and the pandemic across the US. He's got the riots right now, so there's no real need to go back and start bashing China and Beijing.
So it appears we're in a situation that is unfamiliar to most at the moment, which could affect the markets, of course. But let's switch our attention to the economic calendar and specifically Europe. How are the PMIs looking and other data that's been released this week?
It's Wednesday, so today we've got May service sector PMIs. That's particularly important. We're looking for a service sector-driven economic recovery. So these numbers are going to be quite important. So expect the Eurozone and the US ISM non-manufacturing to be the key figures for Wednesday. We then obviously shift back to employment numbers, which are, remain the key areas of focus, that with consumer confidence and spending. So from, the US, we've got the initial jobless claims on Thursday, the ADP numbers tonight, but, let's look at Thursday, the initial jobless claims, and then the non-farm payrolls on Friday, and the unemployment rate. Will the markets be able to stomach a 20% unemployment rate in the US? Probably not. That's going to take some time to bring back down to sub 4% levels. And then you got Canada as well, and they've got employment levels as well, suffering. So those numbers on Friday are due out, and expect that to test the markets as well. So those are the areas we'd like to focus on, over the remainder of the week.
So it looks like employment figures and surveys are definitely in focus right now. We touched upon Europe, but maybe we can go a little bit more detail about what's actually happening on the continent right now.
From Europe, there's two things we're really looking at. We're looking at the ECB on Thursday, so that's going to be particularly interesting. Obviously, the EU and Brussels and member states delivered that quite impressive recovery package to support economies stricken by the COVID-19 pandemic. So what's the ECB's next stance? Because they've been continuing to call for the EU to step up, and they have done. So where's the ECB going? They're unlikely to ease policy further, but they're definitely going to, put their hand up and say that they're going to deliver more support. So that should be positive for, market resentiment. You're seeing the euro on the move, as a result of this material shift in economic outlook. So as long as the ECB doesn't pour cold water on that, then expect the euro to hold on to those 111 numbers and start targeting 112, 113. Then you got Brexit. There's all this talk now of possibly an extension to the transition period. So that's a positive for both sides. Neither side really want a hard Brexit. It's not good for the EU and it's not good for Britain. So let's look at how negotiations go on there, and obviously let's see what the ECB delivers. Economic data, service sector PMIs, due out today. Shouldn't have too much impact on the euro, really, because of that recovery fund.
Seems to be a lot of uncertainties at the moment in the market. Lastly, is there anything positive that we can hold on to and look for in the future?
And finally, anything positive, John? Well, when you look at the COVID-19 numbers, we've seen the four most adversely affected member states in the EU report sub 300 new cases for the second consecutive day on Monday and Tuesday. So, that's a huge positive. We're seeing aggressive easing of lockdown measures, yet we're not seeing this second wave that people were concerned about. And that suggests that, the equity markets in particular may not see that correction that many have been anticipating. Where they're going, though, is a completely different story. I mean, we're seeing levels that, you wouldn't really expect to see when we're looking at, where the economy is right now. But that's definitely a positive. And for the pound and the bulls, an extension to the transition period and hopefully an improvement in relations between the EU and Britain would also be a positive, for Europe and obviously the UK to finally, hammer out that, Brexit agreement that everyone's been waiting for the last 4 years now. So I think those are the two positives that we're looking at this week.
Well, that's all for today, Bob. Thank you so much for joining us, and I'll see you again next time. That was your midweek market drivers. For all the latest information and to keep up to date with all the financial news, please follow us on all our social media outlets.